So let's continue some discussion about indexes. And there is a style of index that's referred to as an unweighted index. That is, all stocks carry equal weight, regardless of their price or market value. So the implications are that there's a little greater exposure to smaller firms. So it'll be more frequent rebalancing within these types of indexes. They could have some higher transactions costs. So how this might ultimately be calculated then. So here we have the beginning price in 2022. Value is 460 here. Here is the values of at 1 year later. And here are the percentage changes in price. So from 20 to 30, that reflects a 50% change in price for a stock X. 15 to 20 is 33%. 30 to 33 is 10%. If you add those all up, 93.3, divide that by the number of shares, then this index is 31.1% in change. So you would take 100 times 1.311 gives us that 131. If it was a market value weighted index, it would only show 119. So again, difference, they both measure the same market, but we get different values because theoretically the concept of how we do this obviously is different. So we also have what we could refer to as fundamental weighted index, where they weight companies based on some kind of an economic measure rather than market prices. So they could look at sales or net asset or book value. They could look at dividends. But the idea here obviously is that market cap weighting can overweight overvalued stocks and underweight undervalued ones. So during speculative bubbles, the ability to catch these things, the overvalued, is obviously is very important in these bubbles, speculative bubbles times that we find ourselves in from time to time. We also have something referred to as style indexes, where these are basically segmented on size, small, mid, large, and then strategy. Are they growth strategies or are they value strategies? And of course, we can also look at some other ideas. We can look at a socially responsible investment index, could be by country, could be by global ethical stock index measures, right? But I have a picture here at the right that shows here's the sizes and then here's the strategies from a value company to a growth company. This is for a mutual fund, ACEIX, right? This is an equity index fund. So what it tells us is roughly we have 37% of the stocks in this mutual fund are in what we would classify as large companies, but companies that are value companies. For some reason, these companies are currently undervalued. Only 2% is invested in large companies that have a growth pattern to them, if you will. Blended means it's a combination of both. But so if we look at how much money is invested in what we refer to as value-weighted companies, companies that might be currently underpriced, we see it's with 37 plus 13, that's 40, that's 50%. Half of this mutual fund is invested in those kinds of stocks. We have many global equity indexes, right? So it's from the FTSE. We have the Dow Jones and the S&P Dow Jones indices also have some global index references, right? But again, these they introduce different aspects, right? They introduce that international flavor. So we have to worry about differences in accounting standards, how they control capital, accessibility, currency effects. So these equity indexes may have some variability in them that makes using them in valuation models may be problematic. We can come up with bond market indexes, right? Relatively new in concept, right? Bonds aren't what you'd call a real sexy part of the investment world. But the challenge with this really is that bonds have limited lives. Sometimes they have some embedded options. Um, Sometimes transparency of pricing is a little suspect. A duration, certainly, the sensitivity of bonds to interest rates has an influence on these indexes. So this makes determining and coming up with bond market indexes a little different, a little challenging. Um, we can classify bond index in many ways, though, right? We can look at aggregates, investment grade only, high yield only, tax exempt. So any of these different types of bonds, we can calculate a bond index for that particular kind of category, if you will. Many investors actually even have a strategy that's really not comparable to a single index. So we can create our own composite index. This happens frequently where you can find a benchmark that is 30% bonds and 70% stocks. Morningstar Direct has many categories, many benchmarks that it uses that are those categories. So again, it's very useful if you really want to understand if you're beating the market. An equity market, an equity index is not a good tool if you're using that to benchmark against an equity income mutual fund, like we said before, where maybe 70% is equity and 30% is debt. So correlation is what really drives the world. We're going to talk about this a lot throughout this course, but we know that the correlation between these different indexes, the correlation can be very high, right? So they are very similar in price movement, but they give us different pictures about the way the world is working. So we'll find that sometimes the correlations are important, right? So this chart shows a couple of markets here and how they appear to follow each other. So they are highly correlated. If you look at the lines here, they look like they're moving in pretty big unison, right? So again, there was a table in a previous video that we had that looked at the correlations across a variety of markets. And it found that there are some that are very highly correlated. So what if we want to invest in security market indexes, right? The two most significant uses are as a benchmark or is to create something else, to create an index itself or an exchange traded funds. So this is closely related because when professional institutions measure performance using these kinds of market series, they've discovered that the vast majority of money managers can't match the risk-adjusted performance of the benchmarks. Managers have a hard time, in quotes, beating the markets. So this has led to the conclusion that many investors shouldn't attempt to beat the market by engaging in active portfolio management that attempts to beat the market, right? So what we should do is just focus on these passive index investments because our efforts at trying to beat the market typically fall short. So again, the task is not to duplicate the market, but to replicate it. Index mutual funds attempt to do this in a low cost, long-term focus, and primarily it works on net asset value based trading. So it looks at a lot at the individual funds themselves. Now, in exchange traded funds are different in that they have intraday trading happens frequently. You can buy and sell them anytime during the day. They are maybe a little bit more tax efficient, and they are fairly flexible if you want to use them for some more tactical kinds of strategies. So the explosive growth of index investing reflects a simple conclusion from decades of data, right? Most investors are better served by capturing market returns efficiently rather than trying to beat them consistently. So what is our closing summary, right? We have security market index define what the market means. They shape portfolio evaluation. They drive modern investment products. So understanding index construction is essential to becoming a disciplined, informed investor. Thanks for listening to the video. See you soon.